Welcome back. This is India Market Open. We're taking stock of the futures and options space. It's turned out to be another good trading session yesterday, especially when it comes to the bank Nifty. Well, conquering 53,000, remaining there, and on the back of the leader, HDFC Bank. The question really is, can we expect more strength to come through? Well, before I get in our expert for today, let's take a look at how things have in fact panned out yesterday. So when it comes to the Nifty, of course, it was a day in the green. We did see the Nifty advance by around 0.7%, but not as much change in open interest. The bank Nifty, on the other hand, was a completely different picture, where we in fact did see the underlying advance by around 1.8%, whopping 14% added in open interest for the July futures, even as we start seeing more longs building into the system. The big takeaway, the Nifty Bank closes at 53,000 and above. Well, moving on in terms of the options market, remember that today is the weekly options expiry, and that's what we're going to talk about. So if you just look at the overall open interest distribution picture, at the moment, a trend that has been coming through is the further cementing of the 24,000 put, or rather the 24,000 level, considering the kind of open interest that we've seen around that mark in terms of puts. Well, moving on the higher end, we have a little bit more writing around 24,500, 24,600. So we're looking at a rough 500 to 600 point odd range in today's day of trade as far as the Nifty is concerned. Do remember that it being the final day of the weekly option expiry, well, the premiums may not necessarily be very high, considering we have seen volatility come off by quite an extent, which does make selling options a little bit of a risky bet in today's day of trade, at least as far as the Nifty is concerned. But let's move on and talk about stocks then. And well, in that case, we have GNFC, ICICI Bank, Shriram Finance, India Mart, all of them looking at fresh longs. Ashok Leyland under a tad bit of pressure, so shorts there. And even among stocks which are seeing unwinding, we have short covering in a whole lot of counters, which would include something like an Ipca Labs, Tata Consumer, and even something like a Biocon. So keep an eye on these counters. But let's take this conversation forward and see what our experts have to make of these markets. Well, we have Rahul Ghosh of Hedge.in, who's joining us on the show. Rahul, good morning. Thanks for joining in. Let's start with your view on the Nifty. What's the way forward, and how are you assessing things here?
Good morning, and thank you for having me. So our view last week around on Nifty was that the room on the upside is a frugal, or there's not much room left on the upside. And that's why, if you remember, we planned a butterfly where we had 24,200 long and we shorted 24,500. That trade is in a small profit as of now, with, of course, a lot of time to play by. That is the exact same view we keep even this week. The upside is limited. We don't know how limited, but better than predicting whether it's 200 points or 400 points. It's always better to form strategies where if the market continues to go up, you tend to make money. If the market stays sideways, you tend to make money. And if the market goes down, you don't lose much money. That's the best thing about options. We continue to hold status quo on that view.
Okay, Rahul, so that's as far as the Nifty is concerned. But I believe when it comes to the bank Nifty, you actually have a recommendation on an option structure you can deploy. Can you take us through that and the reasons why?
Sure. So similar structure as compared to our last week trade on the Nifty. Also wanted to mention to the viewers that we had mentioned Dixon Technologies a couple of weeks back, which would have given about 7,000-8,000 rupees in profit in the structure, the simple bull call that we had created. With respect to Bank Nifty specifically, we are forming a butterfly, but slightly different because we're taking a close by expiry first. It's important that viewers get different strategies and different hands of strategies. So we thought we'd plan something different this time. What we're doing is we're taking the 10th July expiry and forming a simple bull call first with using the 10th July expiry. Current Bank Nifty price spot is around 53,000. We're taking the 53,700 and 54,000 call of 10th July. So we are buying the 53,700 call of 10th July. We are selling the 54,000 call of 10th July. The next step, if this bull call does not work out, if Bank Nifty does not stay bullish, how do we combat this? What we're doing is we're selling the 55,000 call of 31st July expiry. And to hedge that extra sold call, we have the 55,500 call of, we're selling the 55,500 call of 31st July And to hedge that call, we are buying the 55,200 call of again 10th July expiry. So I'm repeating the strikes once again. We are buying 53,700 10th July. We are selling 54,000 10th July. We are selling 31st July 55,500, and we are buying 55,200 call of 10th July. Now, if you look at this structure prima facie, if Bank Nifty goes up before or on 10th July, the structure makes money. Absolutely no questions asked over there, which is about a week from today. If Bank Nifty goes down from this point, the extra sold call of 31st July will ensure that the debit in my initial bull call spread is taken care of. So that's why if you notice, the risk in the trade is only rupees 1,000. It's a very interestingly planned strategy using multiple expiries. The third part of the strategy is that if Bank Nifty moves up slowly, in that case, what we would have to do is the 10th July bought call to hedge my sold 55,500 will have to be rolled over to the end of July expiry once again. That would be the modification in case Bank Nifty moves up slowly.
All right. So as Rahul has put this is actually in two parts. The first part is a simple bull call spread. And along with that, what Rahul is also doing is that he is selling a 31st July, far out of the money call. And against that, he is also buying and a 10 July call, so as to compensate for any just to make sure that the risks are within limit. Now, based on that, I believe that the horizon for this particular strategy will be 10 July. Please correct me if I'm wrong. Are there any adjustments under any circumstances that you may be looking to deploy?
You're absolutely right. So ideally, we are expecting this to play out by 10th July. But the condition by which it won't play out by 10th July is if markets move down sharply or stay at the same range. What happens in that case is that my 55,500 call of 31st July will kick in and will act as a savior to the loss happening in the bull call spread. The only time we would require an adjustment is if Bank Nifty moves up slowly. In that case, what we would do is we would let the 10th July expiry, all the legs expire at whatever price they are on that day. We would roll over the 55,200, which is of 10th July to the end of July, and it would become a simple bull call once again. Right now, the structure is a bull call and a bear call put together. We would change it on 10th July to a simple bear call, keeping the 55,500 leg as it is.
There you have it. That's what Rahul is looking to deploy as far as the Bank Nifty is concerned at the moment. Rahul, on that note, taking a moment to thank you for joining us and taking us through your views on the markets, and also taking us through this strategy, this option structure that we can deploy. And of course, remember that this is across two expiries, not just one. So that's something that you need to bear in mind. But with that, it's over to you, Savina.